Welcome back, ladies and gentlemen. It's Benedict here from Jagging and Company Associates, and still want us to continue with the fundamental principles of accounting. And so far, we've talked about the definition of terms, of which we've talked about what is accounting, and then we've also talked about the basic meaningful ways of accounting. We've talked about accounting process, and then we've also talked about the branches of accounting, and then we've also talked about the basic elements of accounting, and then financial statement we just mentioned briefly, and we'll talk more about financial statements when we are in chapter 2. And then now I want us to proceed with the parties interested in financial statements. So let me just take you back to where we are explaining the parties interested in financial statements, and then here we have the parties interested in financial statements, and we have shareholders. Okay. So when we talk about shareholders, we are talking about the owners of a business, those who have put money, pumped money into a business. They are the owners of a business. We call them shareholders. So when we talk about shareholders, they are interested in the financial statement of a business because they want to know the results of operations, and they also want to know the financial position of the business. And they want to know if the business is making loss or making a profit. In short, they want to know if their interest as shareholders can be met, and the interest of shareholders is such that they will want to be paid dividends, or they will like the shares that they bought within the company, or the shares that they are holding, and appreciate in value over time. So they will want to know whether they will be interested in the financial statement of business. And then we also have investors, and investors, we could talk about bank or the banking institutions as investors. So bank, let's talk, or rather let's take an example where you want to expand your business, but what you have as cash is not enough for the expansion. So we'll go to a bank, and a bank will give you a loan, and the loan maybe you'll service it with interest. So when you go to, when you apply for a loan within a banking institution, they will be interested in the financial statements. The reason being, they want to know if you are in a position to service back the loan as a principal, and also to service the interest on that loan. So they will be interested in the financial statement of your business. Again, you also have creditors. And when we talk about creditors, just means suppliers of goods or services to your business. And they will be interested just to know if you can pay back the services they have rendered or the goods that they have supplied. So if your statement of your financial statements are showing a bad picture of your company, then the suppliers will be hesitant in supplying you with goods and services. So they must be interested in the financial statements of your business. Then we also have labor, and labor here we just mean employees. And talk about employees, they will be interested in your financial statement of your business because they want to know if you're in a position to pay back the salaries. So employees will work, maybe you need to pay them monthly or maybe weekly. For weekly, here we'll be talking of wages. So they must be interested in your financial statements because they will know if you're in a position after rendering their services, you'll be in a position to pay them salaries. And then again, we also have the government. And when we talk about the government, government will be so much interested in the business because they want taxes. The government is always being run by the money they get from the businesses in form of taxes. So they will want to know if you are in a position to pay income tax, if your employees are in a position to pay as you earn, the business in a position, if it is an export or import, they're in a position to pay excise duty. Or if you are selling goods and you are adding value added tax, are you able to remit the value added tax in time? So they must be interested in your financial statements. And lastly, we also have here researchers. So researchers will be working on accounting theory. They'll be doing research on accounting theory. And when they are doing their research, they must be interested in the financial statements of the business to know how the business is operating, how the business is being run, as that will be part of their research work. So moving on again, now we have accounting concepts, we have rules, and we have conventions. So we don't just do accounting, we must have rules, and we also must have concepts and conventions. So when we talk about accounting concepts, we have quite a number, and what we mean here by accounting concepts are this business concept, cost concept, measurement concept, dual aspect concept, and the rest. So what do you mean about money measurement concept? When we talk about money measurement concept, we mean the concept, rather we mean that as accountants, we must treat a business as distinct from the owners. So when you are operating a business, your business should be separate from you. You cannot be one. The business cannot be one and the same of the owners. You must separate the business, and you also must identify that this business is doing ABCD, and it's separate from the owners. So the business must be treated separately from the owner to allow separation of business from private affairs. If that means that when the individual that owns the business or the parties that own the business, when they incur some expenses as privately, the private expenses should not be part of the business. Their private expenses is their private expenses, and the business expenses must be business expenses, or business assets must be business assets separate from private assets. So that's why we are talking about the business entity concept. The concept means that accountants must treat a business as distinct from the owners. And then secondly, here we also have a concept, and cost concept is so simple. It's all about the transactions being recorded in the books of account in terms of the actual amount that is involved. So for example, maybe you've bought, let's say you bought land, and land is worth, you bought land worth $6,000, but you feel that the value of that land is $7,000. So what needs to be recorded in the books of account is $6,000, but not what you think the value of land is $7,000. So what we'll record is the $6,000, the amount that has been involved in the transaction. That's what we mean by cost concept. And then we also have here money measurement concept. And this one says that only transactions that can be measured in monetary terms are recorded. So if you have transactions that you cannot quantify in monetary terms, we cannot record them in our books of accounts. We only record transactions that we can measure or quantify in monetary terms. And then we also have a dual aspect concept. And the dual aspect concept is saying that in every business transaction, there must be a record in two different accounts. In short, for every transaction must be fully part of accounting equation. And the accounting equation here is asset equals equity plus liabilities. So what do we mean by dual aspect concept? For example, let's say you are in a business and you've invoiced your customer. So when you invoice your customer, you must earn revenue. So you must record the revenue that you are earning, and then the revenue that you are earning must also affect a different account as well. So when you invoice a customer, you've earned the revenue, but the revenue, the money, or rather the money that should come into your to your business, maybe in terms of cash, or maybe it will be paid in future. So when you invoice the customer, you'll record revenue. So revenue will be income that will be recorded into your account. But again, when the customer pays you, you'll record the cash. Rather, you'll record the cash as an asset that is now income to the business. Now you see here we have two aspects. We are recording cash incoming, or debtors or receivables when the customer is not paid. But on the other hand, also we are recording we've earned revenue. We are recording revenue on the side of on the side of equity. Rather, we are recording revenue as an income, and then also we are recording receivables when the customer is not paid in cash, or when the customer is paid in cash. We must record the asset, the cash value. We must record money that has been transferred to the bank, or that cash that we've received from the customers. So we are talking about the dual aspect concept. So it means that for every transaction, two accounts must be affected. Asset account, or rather the asset side, must be affected, and the other side of equity and liabilities, one must also be affected. So we either affect asset with equity, we either affect equity with liabilities, or we either affect assets and liability as a dual aspect concept. So let's move on. Then we also have accrual concept, and the accrual concept states that all transactions, whether settled in cash or settled in later date, must be recorded. It means that all revenues and expenses are recorded when incurred and when cash is paid. Okay. Rather, we record all revenues and expenses when we've incurred them and not when cash has been paid. For example, you've invoiced a customer and the customer will pay you after maybe 30 days. At the point when you are invoicing the customer, you must record that revenue. You don't wait the customer to pay you after 30 days. It's when you record that you've earned the revenue. So this is how we talk about the accrual concept. Another example is when you've paid rather an employee has worked for you, but you need to pay the employee after 30 days. So you don't wait for the employees to be paid after 30 days is when you record that expense. So you record the expense when you've incurred that expense. you record the expense when the service has been provided by the employee. So that's how we deal with the accrual concept. Again, we also have here the matching concept. And the matching principle concept asserts that revenues and expenses be recorded in the same period. The two are then merged to ascertain the profit or loss of the business within that accounting period. So, simply put, when you incur revenue, you record them within a particular period. Like now, we are in January. So when we invoice customer, we need to record that revenue within January. And then when we pay employees for the services rendered in January, we need to record that expense in January. And the revenue that we've incurred or that we've earned and the expenses that we've incurred, we need to match the two expenses within the month of January to ascertain whether we made a profit or loss within the month of January. So we are saying matching principle means that revenues and expenses be recorded in the same period, and the two must be matched together within that accounting period to ascertain whether we've made a loss or a profit. And then also we have here realization concept. And realization concept here states that revenue can only be recognized in the books of accounts when the underlying goods and services associated with the revenue have been delivered or rendered. Revenue can only be recognized in the books of accounts when the underlying goods and services associated with the revenue have been delivered or rendered. Simply put, you can only recognize revenue in your book of accounts when the services have been rendered or when the goods have been delivered to the customer. When you are selling goods to the customer, and let's say the customer has given you a quotation, you've also done your pro forma invoice, and then now the customer has accepted the pro forma invoice, so now you need to deliver the goods to the customer. Before you deliver the goods of the customer, you cannot say that you've earned the revenue, so you cannot record that one as revenue. So you only record that as revenue when you've transferred the goods to the customer. The customer has accepted the payment and the terms of payment of those goods. So then you can record, or rather, can realize the revenue and record them in your books of accounts. So we also have accounting conventions, and when we talk about convention here, we mean a common practice used as a guideline when recording a business transaction. And it is used when there is no definite guidance from accounting standard to govern the situation. So we are saying a convention is a common practice used as a guideline when recording a business transaction, and it is only used when there is no definite guidance from accounting standard or accounting rule to govern the situation of that transaction. So when we talk about conventions, what are they? So when we talk about conventions, we mean consistency. So here consistency, here we mean the accounting practices or accounting principle. That means accounting practices or accounting principles should remain the same over time. If there is a change in accounting practice, there must be a reason to that, and the reason must be disclosed as a footnote to the financial statements. What do we mean by consistency? Like now, let's say we have assets, we have computers, we have vehicles, and we have furniture. So when we buy furniture, we'll classify furniture as furniture. When we buy vehicles, or rather motor vehicles, there's a class for motor vehicles. And then when we buy computers, there's a class for computers. So computers, motor vehicles, and furniture, they are assets. But these assets, they lose value as you continue using the asset. So the way you need to identify the loss of value of an asset after every given accounting period. Like now we have computers, we have motor vehicle, we also have furniture. So let's say you've said, let's say you've assumed furniture is losing value of, let's say losing value of 20% within a year. It then means that when every time we buy furniture, we'll subject it to 20% loss of value. So that's what we mean by consistency. When we buy a motor vehicle and we assume that it is losing value of 20% each and every year, it means that each and every year the motor vehicle will be losing value of 25%. And when this year it is 20%, the now year it is 25%, and the other year again is now becoming 12%. We must be consistent with the value that we are using to depreciate the motor vehicle. When it is 20%, rather when it is 25% for the motor vehicle in the first year, it has to be 25% for the motor vehicle in the second year. It has to be 25% for the motor vehicle in the third year, continuously. So we are saying we have to be consistent. That's what we mean by being consistent with the accounting practices and principles. So consistency here does not only mean the depreciation of value. It means the accounting practices. Okay, when you are generating your financial statements on a monthly basis, it means after every month you must generate your financial statement. After every month you must generate financial statements, and you cannot generate financial statement after 1 month. Then you wait again after 6 months, you generate another financial statements. Then after 1 year again, generate financial statements. You do it monthly, and cumulatively. So that's what we mean by consistency. And then we also have here disclosure stroke materiality. So we say here it is a good accounting practice to disclose all significant information. So disclosure goes with materiality. What is significant in accounting terms has to be material. And when we talk about materiality, we mean the monetary value involved. We can say maybe $1,000 its of value is material, or an asset worth $1,000 is material. But what about an asset worth $0.05? Is it material? We need to disclose $0.01 of an asset. So we are saying it is good accounting practice to disclose all significant information. Various assets must be stated and their mode of valuation must be disclosed. Various types of revenues must be properly grouped and disclosed. The disclosure will depend on the materiality of the items involved. The materiality depends on the amount involved. So you cannot disclose 0.01% as the value of an asset when the materiality of the value of assets that you are disclosing is maybe $50 or maybe $1,000. So 0.01 of a dollar will be material. So you only disclose values with significant information and of significant value. So we also have another convention here called conservatism. And when we talk about conservatism, we mean a principle, rather conservatism principle is the general concept of recognizing expenses and liabilities as soon as possible when there is uncertainty about the outcome, but only recognize revenues and assets when they are assured of being received. Okay. So it then means that you cannot just recognize revenue. You can, let's say, you can assume that maybe in the next 2 months, I will be doubling customers. I will have twice the number of customers that I'm having in January. So in 2-3 months, rather in February or March, my customers value. So when the value of your revenue in January is let's say $6,000, and you are saying in 2 months' time, the value of a customer will have increased by 100%, meaning $12,000. You cannot use that to decide that now you've earned revenue worth $12,000. You only recognize revenue assets when they are assured of being conceived or rather being received. So when you're assured that you'll receive a revenue worth $12,000, it's when you can recognize that revenue. It means that you must have invoiced your customer to receive $12,000 as opposed to anticipating that in the next 2 months you'll get customers worth $12,000. So we are again saying that the aim of this concept is to protect investors from potentially inflated revenues and assets. This approach limits any understatement of liabilities. Okay. I think that is straightforward and you can understand. It aims at protecting investors from potentially inflated revenues and assets. So you cannot anticipate that your assets will be valued this much and your revenues will value this much, and then you increase their values when you've actually not earned or received the value of those assets and revenues. So that's what we mean by conventions, and those are the various conventions that we have for our accounting. So let's move on to accounting rules and system. So in accounting, you don't just count, you must have rules. You also must have a system. So we have the double entry rule, and the double entry rule, simply put, is that for every debit entry, there must be a credit entry. And for every credit entry, there must be a debit entry. But before we talk about the accounting rules and system, let's try to understand what we mean by debit, credit, and accounting equation. So I will jump from the accounting rules. So we'll come back later to it. And then I'll move to debit, credit, and accounting equation. So when you understand this debit, credit, and accounting equation, then it will be easy to understand the accounting rules. So here we want to talk about credit, or rather, we want to talk about debit, credit, and the accounting equation. So what do we mean by debit? So when we talk about debit, mean a debit is an accounting entry that either increases an asset or expense account or decreases a liability or equity account. It is positioned to the left in an accounting entry. So we need to do this by an example. So here we'll just take it to this Excel workbook. So here we are. So here is an accounting entry that we want to make, and we've said a debit. We've just said a debit is an accounting entry that either increases an asset or expense account or decreases a liability or equity account. It is positioned to the left, the accounting entry. So before I take you to the Excel workbook, I want us also to understand what we mean by credit, such that when we go to the Excel workbook, we'll try to do two examples, both for debit and both for credit entry. So what do you mean by credit? Okay. So we talked about debit, but we also have a debit note, and we just say debit is an accounting entry that either increases an asset or expense account or decreases a liability or equity account. It is positioned left on an accounting entry. And then after the debit entry, we also have credit. So we are saying credit here. We've talked of debit, and now we want to talk about credit. And you're saying credit is an accounting entry that either increases a liability or equity account or decreases an asset or expense account. It is positioned to the right in the accounting entry. So before I talk about debit note and credit note, let's try to understand debit and credit in the Excel workbook. So I'll come here, this Excel workbook. So this is an accounting entry. So let me just call this one bank account. And then also and create another account. I'll call this one creditors account. So we've said a debit will increase the value of an asset and decrease the value of liability. A credit here is a liability and debit here is an asset. And then you've also mentioned again that a debit also will increase the value of an expense and reduce the value of income or revenue. Okay. So this is an asset, this is a liability. So I also want to get another one here for an expense and another one here for revenue. So here again I will copy this entry. Here I will call this one salaries account. And we'll paste the same here down here. I will also copy this. And paste here. Okay. So we are saying when we debit, we are saying a debit will increase an asset and expense as well. So here we have an expense. So let me call this one an expense. This one is expense. And this one is an asset. Then when I come here, this one is a liability. Then go down here. This is revenue. So revenue is revenue, or it is it's income. And then click another one for. Let me just click another one for capital. So this one I'll call capital account. Capital is not liability. So we've said debit will increase an asset, will also increase an expense. It is located on the left side of an account, and then creditor, rather credit, will increase, will reduce an asset. It will also reduce an expense, and it will increase liability, and will also increase capital. It is located on the left side of, rather the right hand side of an account. So let's say you have bank account and you are opening balance. So this is your bank account and this is an asset. You have opening balance. You have opening balance of 1,000. Let's say $10,000. And then okay, let's assume that you started a business with the $10,000. So whatever you put in your business was capital. So you had a capital of, let's say, balance, opening balance 1,000. So you've said debit will increase an asset and it will reduce the liability and capital, and then credit will increase capital and liability and will reduce the asset and expenses. So let's say you've taken a loan, not actually taking a loan, you're buying goods worth 5,000. So when you buy goods worth 5,000, you'll debit the assets account, you'll debit the goods account. Let's say this is an account for purchases. Okay. So you're buying goods worth 10,000. I mean $5,000. So when you buy goods worth 5,000, it means money will come from your account, and then you'll be buying goods. You'll be having goods worth 5,000. And the purchase account will have, this one is still zero. So here we'll say bank. Of course, the purchases, they are goods. I'm talking of purchases account. So we are purchasing goods. So under this purchase is where we have goods. So here mention where bank is coming from, where the amount is coming from. We've bought goods for 5,000, but the money has come from banks. So I'll say bank. We used 5,000. So we are saying when we debit, we increase the value of an asset. So purchases are assets. We're purchasing their assets. We are purchasing assets. Or let's say, let me not confuse you with assets. Let's say this is furniture. This furniture. So furniture account, we bought furniture worth 5,000, but the money has come from the bank. But under furniture now, we have to mention where the money has come from. So we are writing bank 5,000, but the value of the furniture has increased. But now the value of the bank is reducing because for every credit entry, for every debit entry, there must be a credit entry. Already you have debited furniture with 5,000, and there must be a credit entry. So we must credit the bank account because the money is coming from bank account. We must credit bank account with 5,000. So here we'll write here furniture. $5,000. Okay. And then now after crediting furniture, we've just utilized the credit entry. So we are saying when we credit an asset, we reduce the value. The value of that asset decreases. So here we've just decreased the bank as an asset. We've decreased the bank as an asset by buying furniture worth 5,000. So apparently now our balance carried down here. And say balance carried down. Let me just write balance carried down is 10,000 minus 5,000. So I will take sum of. Let me take sum of. So I'm taking the sum of the values that I will debit in this account minus the sum of values that I will credit in this account, and enter. So we are saying our balance carried down. So it means that the amount that has remained in our bank account is 5,000 after buying furniture worth 5,000. And then in our furniture, balance carried down is also sum of the value of the furniture that we'll buy, whether in cash or in credit, minus the sum of values of assets that we will dispose or sell. Okay, so the balance carried down for our asset or the value worth in our furniture account is 5,000, and then the value carried down in our bank account, or the amount that has remained in our bank account is 5,000. Again, let me say let me now do another example with expense. Let's say we also paid salaries worth 2,000. So when we pay salaries, we've said when you debit salaries account, or rather when you debit an expense account, it will increase um, the value of that expense, and then it will reduce, debits will reduce the value of liability and capital and will increase the value of assets and expenses. So here we want to pay salaries worth 2,000. So let's say we are paying salaries worth 2,000. Let's just say here we want to pay, here we'll mention bank, money is coming from bank. So here we mention bank, but we are paying 2,000. Then, but again, since for every debit entry, there must be a credit entry, and this money is coming from bank. So it means that we must have a credit entry in the bank side to show that paid salary is worth 2,000. So again, I will come here to bank. Here now we'll write salaries because I'm mentioning account that has been paid by 2,000. Salaries, now it is 2,000. So our balance carried down is 3,000 because we had initially 10,000. We bought furniture worth 5,000, and then we also paid salaries worth 2,000. But in our salaries account, we have balance carried down. Some of all the salaries that we'll pay minus sum of all the salaries. Maybe we will reduce the salaries, we don't know. Maybe maybe we are getting we've given our employees some loan, so we need to deduct money from their salaries, so we'll get that when we credit the account. Okay, so here you see for every debit and credit entry, for every debit entry there must be a credit entry, and for every debit entry there must be a credit entry, and we are saying debits will increase the value of an asset and salaries, and they will also reduce the value of capital and liability. So when we debit a liability account, we are reducing the value of that liability account. When we debit the capital account, will reduce the value of that capital account. But when we debit an asset account, expense account, we are increasing the value of that asset or of that expense or asset account. So here we've debited expense account and also credited the asset account. So asset account has been reduced by 7,000 for furniture and salaries, and then we've increased the salaries account by 2,000, and we've also increased the furniture account by 5,000. So again, now let's work with the credit. Now I want to use credit entry. Rather, I want to make a credit entry to show that credit will increase the value of liability and reduce the value of an asset or expense. So now let's assume maybe you've gotten a salary, rather you've gotten a loan from you've gotten a loan from a bank. So let's not talk about a loan. Let's talk about a supplier supplying with goods. So you've a supplier has given you goods worth 6,000. Okay, goods worth $6,000. So here, let me change this one to purchases account instead of revenue, and it to purchases account. This is giving you goods worth 6,000. So let's call this one, we call it supplier. Let's call this one creditors. So from creditors, we've got goods worth 6,000. So here, purchases here, we consider purchases as let me talk of stock, not purchases. Purchases will confuse you, but let me talk of goods stock account. Okay, so we've bought goods worth 6,000. So out of the goods, we have creditors. So we are getting these goods from creditors. So under creditors account, we also must credit the same, because for every debit entry, there must be a credit entry. So here we want to say stock. Stock here we've bought stock worth 6,000. Okay. So here we've debited stock and credited creditors. We've purchased stock worth 6,000. And the stock that we purchased, the value of those stock have come from creditors, but we are buying them in credit. We are not buying them in cash. We are buying them in credit. So here the creditors will be worth 6,000 for the stock that they have supplied. So here we'll have balance carried down. Will be equivalent to sum of all. So here balance carried down should be on the left hand side, rather the left hand side. Equivalent to sum of all the credit purchases minus sum of all the amount that we'll pay to our suppliers. So the same applies here. The balance carried down will be balance carried down equivalent to sum of all the stocks that we've sold minus rather all the stocks that we bought minus all the stocks that will be selling. So the balance carried down for stock is 6,000. Balance carried there for creditors is 6,000. So let's assume maybe you've decided to pay our creditors 1,500. So creditors, we want to pay them 1,500 for the stock that they've delivered. So we owe them 6,000, but we want to pay them 1,500. So when we pay here, we'll debit the account because we are reducing the liability. We'll debit the account. We just said debits, they will reduce the liability and capital, and they will increase the assets and expenses. So if I debit here, so here if I'll say bank, and then we are paying bank here. We are paying creditors 1,500, and then money is coming from banks. So here I'll write creditors. So here we'll be writing 1,500. So here we are showing that for every debit entry, there must be a credit entry. We've just debited creditors by 1,500. So we must also credit bank by 1,500. And again, we are saying debits will reduce the liability and they will increase, rather debits will reduce the liability or decrease the liability, and they will increase the asset. So here we've debited the asset by 6,000. We also credited liability by 6,000. Here the credit will increase the liability and the debit will increase the stock. But when it's done opposite, now we are saying when we debit the liability, we are reducing the value of that liability. When we debit liability or creditors account, we are reducing value of creditors by 4,500. But when we credit the bank account, we are reducing the value in our bank account by 1,500. So our balance carried down here is 1,500. Then let's assume again we are injecting more capital. Let me just write here balance carried down for capital. Balance carried down. Capital will be the sum of all the capital that we've injected minus all the reductions we've done in our capital account. So this we need to start from left. Okay. So let's assume you are again getting a loan account. You are getting not a loan account, but you are getting you're not getting. You are injecting more capital. Should be opening balance. You are injecting more capital to your business. So you are adding maybe you are adding 5,000. So let's say you're adding 5,000, and then 5,000 that you're adding, you're transferring to the bank. So I'm saying bank will receive 5,000. So now your balance carried out for capital will be 10,000, but then your bank again has to receive 5,000. So here you're saying capital from capital account, that is you're receiving 5,000. So the balance carried down in your account will be 6,500 as opposed to 1,500 because we've just received injection of capital to your bank account worth 5,000. So again, we can also say now we want to pay again. Let's say we want to pay salaries. You want to pay again salaries worth 2,000, or we want to buy furniture. Let's say we want to buy furniture worth another 2,000. So again, I will come here to furniture. Say bank is buying furniture. This is 2,000. And then we are saying for every debit entry, there must be a credit entry. So we just debited the furniture account. We also must debit bank because we are buying furniture using our cash from bank account. So we'll come here and debit bank, rather credit bank, the same amount. So here is the right here furniture. I bought furniture worth 2,000. So now our balance carried down, or rather the value that is within our bank is 4,500, and the balance carried down for our furniture is $7,000. So ladies and gentlemen, I hope you understood how to work with the debit and credit, and you've understood how the debit, for every debit entry there must be a credit entry, and how the debit will increase expense and assets, and will reduce liability and capital, and then how the credits will increase the liability and capital and will reduce the assets and expenses. Okay. Now debit note and credit note, and then we'll call it a day for today. So when you talk about debit note, we are saying a debit note, or a debit note, or I'm talking about a debit note, this one here. A debit note or a debit memo is a document issued by seller to buyer to notify them of the current debt obligation. You commonly come across these notes in the business to business transaction. For example, one business may supply another with goods or services before an official invoice is sent. The debit note recognizes the transaction for documentation purposes. So when you sell goods to your customer, and then maybe the goods are worth $5,000, so you'll send a debit note to your customer, telling them that the goods that have been sold to them is worth 5,000. But a debit note is not an invoice. It will not give the details of the items that have been sold and the date that they were sold. It will only show you the value. It will only show you the value amount of what is owed by customer. Again, we are saying a debit note is also given when a customer returns goods to a business received on credit. So when you sell goods on credit, when you sell goods on credit and a customer returns those goods, the customer will send you a debit note. So this debit note is to his account will be debited on his the liability side, and on your side it will come like a credit note. On your side, when you are selling, or rather on your side when you receive the debit note, it will be recorded on the it will come to customer account, reduce the value that the customer ought to have paid you because the customer has returned the goods. So you must reduce the value of the goods that the customer needs to pay. So in your account, it will be a credit note to the customer. You'll be crediting the account of the customer with the debit note. On the customer side, because what he is supposed to pay you is a liability, he will debit that account of liability and reduce the value of the liability. So the debit note is also given when a customer returns goods to a business received on credit. In this case, the buyer issues the debit note to the seller. Okay, and then we also have credit note. I think we had explained the credit. Now we need to explain credit note, and then we are saying credit note is a document issued by a seller to a buyer to notify that a credit is being applied to their account. A credit note is a document issued by a seller to a buyer to notify that the credit is being applied to their account. For example, you are a seller, you've sold some items, but after selling the items, you realize that the items that you've sold are not the correct, are not of the correct items that were required by the customer. So you need to take them back. Maybe you need to take 2 items back from the customer, or the value of the items that you've sold is not worth what you've mentioned to the customer. Now you need to reduce their value. So in this case, you'll issue a credit note that will reduce the value of the items that you sold to the customer. So the credit note on your side will reduce the value that the customer needs to pay you. And then on the customer side, when he receives the credit note, that credit note will reduce the value of what is supposed to pay you. So it will debit the account, which shows that he owes you some amount of money. It will debit the account. So we had mentioned debit is an accounting entity that either increases an asset or expense account or decreases the liability or equity account. So from the customer side, the amount that he needs to pay you is a liability. So when he receives a credit note on his side, that credit note will be a debit note. He will say that we will receive a credit note, but when he effects that credit note, it will reduce the liability on his side that he owes to supplier. So that's what we mean by credit note. So ladies and gentlemen, let's stop at that, and thanks for watching, and we'll continue and we'll continue with the accounting rules and system when we come back on the next video. So now we've mentioned what is meant by debit, what is meant by credit, and the accounting equation. So when we come back, we'll do the accounting rules and accounting system. So thanks for watching, and let's meet again on the next video.